All right, we're going to go ahead and get started with our last session of the day, which naturally is the last roadblock between all of us and the bar. Let me introduce our speaker, Eric Nath. He's a senior ASA in business valuation and has been valuing private companies for nearly 30 years. His focus is principally on fractional and partial interests in entities and undivided interests in real property. Projects include gift and sale transactions, estate and income tax matters, charitable contributions, stock option plans, recapitalizations, dispute resolution, litigation support, and dissolution bankruptcy proceedings. Eric served as on ASA's Business Valuation Committee in the early 1990s and has been actively contributing member for the Business Valuation Standards Committee since that time. From 2003 to 2009, Eric was the principal author and driving force for the adoption by ASA of Procedural Guideline 2, Valuing Partial Ownership Interests, which is now part of ASA's Business Valuation Standards. He also developed and taught ASA's graduate level courses, business valuation, discounts, and premiums. Eric is well known for his many articles and presentations on control premiums and minority interest valuation issues, such as his 1997 Business Valuation Review article, How Public Guideline Companies Represent Control Value for a Private Company. Today, he will take all of this past thoughts and ideas to their logical conclusion and demonstrate how you can forget everything you thought you knew about discounts. Please welcome to the podium, Eric Nath.
Thank you, Eric. What I want to do really today is not just talk about discounts and what you do with discounts. What I would like to talk about is the bigger issue of how to value non-controlling illiquid interests in private companies. This is one of the areas that has been sort of danced around in our profession, and we've talked about costs of capital and valuation of companies and how to value a company. Very little has been done in terms of really focusing on partial interest, fractional interests, non-controlling, illiquid interests, other than to talk about discounts. And what I would like to do is expand the conversation just a little bit. We really actually need a whole conference on this topic because it really is an enormous discussion. One of the things that I have found in the last few years is that there is a big disconnect between the taxonomy of valuing a company versus valuing the minority interests in that company. And so what you get when you mix these ideas up is you get cases like the Richmond case, which is so bad in so many ways. That is one of the reasons I wanted to do this presentation, is to talk about the specific things that go on in valuing minority interests versus controlling interests. I started business valuation in 1985. This was not too long after Shannon wrote his book on how to value a company. And I was with Bank of America in the trust department. We would value private interests for the trust group. I think we had something like around 1,400 minority interests and private companies in the trust group that needed to be valued. And one of the most difficult things that we faced at that time was figuring out what these things were really worth. And of course, at that time, there was precious little beyond valuing a company on how to manage this kind of process. And of course, we had data on restricted stock. We had data on the differential in value between the company before it went public and the company after it went public. So John Emery got busy and did these pre-IPO studies. We had, and at the time, of course, everybody was going through the business schools and going through CAPM and all that sort of thing. and looking at all this data from Roger Ibbotson and all this historical interesting information from CRISP that was able, you could parse it and figure out what costs of capital were. We had the control premium studies. And so, you know, because public companies get taken over and there's a premium, so there was an analysis of the control premium studies to figure out what the value of control was, and by reciprocal of that was the value of a minority interest. But it was all this incomplete data, and we didn't understand what this data meant. We were extrapolating from data that we didn't understand, and we made some very wrong assumptions about what it meant. One of the things that we forgot to do when we looked at the control premium studies, when we looked at the pre-IPO studies and the restricted stock studies, was to ask why. Here's this data. It looks like something, but nobody ever thought to ask why. Why are there these discounts? What's driving these factors so that we just took the data and extrapolated it? What I wanted to do today was take a look at some of the conventional wisdom that we have in place at this point and talk about how the income approach could be a better solution for our problems in valuing private minority interest. And one of the things I would like to recommend to you is to take a look at ASA's Procedural Guideline 2. This is the only guidance that's in existence today that takes a comprehensive view of how to value private minority interests. What I want to focus on first is the conventional wisdom. The way this works is you value the company as a whole, either as a going concern or on its net asset value if it's an asset holding company. It doesn't really matter what's underneath it. We want to get the value of control. Subsequently, the theory goes you take discounts for lack of control, lack of marketability or liquidity, and perhaps some other discounts like a built-in capital gains tax. And from that, you then can derive a fair market value. Well, the problem with this is that nobody in the real world, meaning people who actually put money into deals, use this approach. The only people who use this approach are the appraisers and the courts. There's no actual investor who actually goes through this process. It doesn't work. Why am I confident that this does not work? For two reasons. First, because people don't use this approach in valuing private minority interests. And the second reason is you can take every one of those components and you can disprove it. So if none of the components actually work and nobody actually uses it, why do we think as appraisers that we can use this kind of an approach? So I need to do two things today. The first is I need to take apart some of the discounts and look at why they don't work. And the second thing is we need to get into the income approach as buttressed by the market approach. The first thing we need to look at is discount for lack of control. Now, there isn't any empirical evidence, none, that exists on the value of control or lack of control in a private company. This does not mean that it isn't extremely important, but we don't have any way to measure it yet. We've talked about discounts for lack of control and premiums for control. This slide shows kind of the general data that people point to get to an implied minority discount using average control premiums and median control premiums, and then taking the reciprocal based on the assumption that it is actually that it is a control premium. And I think that what we are coming to the conclusion is that it is a transaction premium based on market participants, what was missed in the controlled premium studies is it doesn't actually show a differential between control and lack of control, because the mistake was that publicly traded shares trade as minority interests. They are minority interests, but they don't trade like it. They trade it like very close to their control value, and most of the time, many times I've done appraisals where they traded above their transaction potential M&A value. And the reason is liquidity. The value of liquidity eliminates all of the problems that you have that you can't, because you can't control the public company. Well, not only that, those prerogatives of control that are listed in the books are really the kinds of things you wouldn't want to have. You don't want to have any control over this company. It would completely defeat the purpose of being a public company. The purpose of being a public company is to give you control over your investment. So if you can sell your investment anytime you want, the last thing you want is control over the company. The transactions that show these premiums are really from a controlling position to a controlling position, because the public company is already controlled by the board, by the management, and ultimately by the shareholders. It's not like there's a differential between minority and control. It's a control seller and a control buyer. We've gone through this an awful lot in the last few years, and I don't want to belabor it too much. This does not work. It is completely bogus. The problem is, I continue to see this in reports. People keep putting it in as if there was some truth to it. Now, this just gives you some sense of the kinds of articles that have been written by people to say this whole idea of a control premium and a discount for lack of control from these transaction data is hogwash. And so it's not just me. There's a whole wave. And by the way, that no one has ever rebutted this idea. And so if science is getting data, developing a hypothesis, and then testing it with fresh data, no one has ever rebutted the hypothesis. So I have to assume that it's true. All right, so now we're going to talk about closed-end fund discounts. And of course, this goes to the Richmond case, and it goes to a lot of other cases in tax court. People get the closed-end funds. They look at the discounts on closed-end funds, and they assume, because the closed-end fund, you can't control the portfolio within the closed-end fund, that the discount on the closed-end fund gives you a discount for lack of control. Well, so this is the data that the courts will see. And of course, the courts buy it, and they incorporate it into their decisions. What happens here is that most of the time, in putting together this data, appraisers will eliminate the premiums at which closed-end funds are trading, right? Because they don't support the theory. It's absolute hogwash to take data out if it doesn't support your theory. Read Standard Deviations by Gary Smith. It is an incredible book, and it's a book about statistics. And of course, you buy stuff like that, right, so you can read it before bed and go put yourself to sleep. This is one of the most exciting books I have read in a long time. It talks about stuff like this where you throw data away that doesn't support your theory. Well, guess what? Closed-end funds, and I've got a couple of them here, trade at premiums, they trade at discounts, then they trade at premiums, then they trade at discounts. On the top line there, we have a muni fund, closed-end fund, during 2011 and 2013. The net asset value varies all over the place, of course, but they standardized it to a zero line. It shows you that it does. It trades at discounts, it trades at premiums. The same thing goes for the chart on the bottom line, where the green line is the net asset value and the orange is the price. Well, you know, this just goes to show you that publicly traded shares, which closed-end funds are, tend to trade at or near control value. Sometimes more, sometimes less. This is what we call a crackpot theory. Closed-end funds do not work. Please eliminate it from your practice. If you ever go to court and you get any kind of an attorney that's half awake, you will be Dauberted out, because this is the most idiotic thing you can imagine. I mean, those are the only things that I know of that talk about lack of control. So I don't think there's any data. Of course, you still have to embed it somewhere in your analysis, because you don't have control over the company and you don't have control over your investment. And so therefore, it's a huge problem that has to be considered. Let's talk about marketability and liquidity discounts. Most of this stuff comes from pre-IPO studies, option pricing methods, and restricted stock studies. Let's talk about these in order. And of course, the pre-IPO studies are absolutely bogus. I was watching a PBS NewsHour last week, and there was a story about technology companies that fail. In 2013, according to Crunchbase, there were 19,500 companies that received venture funding. In 2013, a little over 200 companies went public. If you think survivor bias is something that can be overcome, you need to think again. Because this is like 1%. This is the 1%. And so if you ignore all the companies that received venture funding but never went public, so there's no way to measure that discount, you're just missing 99% of all the data. Now, some of those companies obviously get sold, or something else happens to them, but most of them just disappear, and all their investors' money is gone. This does not give you what you think it gives you. Please get rid of it from your practice. Now, I have never seen an option valuation method that made any sense in a private company context. I mean, option pricing theories, option pricing models hardly work in the option markets, much less, I mean, putting it into sort of a private company context. I don't know enough about option pricing to be able to say this is absolutely bogus or hogwash, but I think it is. Part of the reason I think it is because nobody who's actually going to buy a private minority interest is going to use something like this. Now, we're going to move on to restricted stock. What you see here is a chart from Stout Reeses Ross off their website. And this is the stuff that really kind of might have some validity, but not in the way you think. At the top, you have studies that were done way back in the 60s and 70s and 80s. In 1990, there was a change in the rules, 144 rules, which allowed more freely the restricted stock to be more freely traded. And what happened is that it became somewhat more liquid. And so institutional buyers could get in there and they could buy this stuff. And what that did is it kind of squeezed the discounts down from about 35, 40% down into maybe 20, 25%. All right? But it was still a 2-year hold. 1997, they went from 2 years to 1 year. And then in 2008, went from 1 year to 6 months. A lot of people will look at this chart and forget the fact that you have a completely different holding period. So what people do is they say, some people who have a reason to get a higher value will say, oh, the discounts for lack of marketability have gotten smaller over time. Well, you know, there's a reason for that. And the reason is that the holding period has gotten shorter and shorter. So the shorter the holding period, pretty soon you get to a public stock value, right? You get a 0 holding period and you get a 0 discount. Now remember, those numbers on that chart were original issue discount stock. What those do is the company goes out, and basically it's a way to slide in a secondary offering, otherwise known as a private investment in public equity pipes. Slide that out there and sell some stock to get some more capital without having to actually file for a secondary offering on the public markets. And so that's the original issue discount study material. We also have actual transactions between third parties in restricted stock. And Espen Roback was one of the people at Plurus Valuation who studied these transactions between actual third-party investors having nothing to do with capitalization of the company, but these transactions would occur on restricted stock trading network and second market and those kinds of platforms. So he went and looked at the transactions between independent third parties and found that the same kind of pattern happens here, but it's actually bigger discounts for shorter holding periods between independent third parties. And probably part of that has to do with the fact that the company's not really getting anything out of that. One of the things he did was he put together some confidence intervals from that data. And this is not data. This is confidence intervals to show that as time goes along, the discount gets bigger. And what's remarkable to me is that you get the confidence intervals, you know, cover discounts of 50%, you know, average 50% over not very long time, about a year or so. From that, what you can do is use that incomplete data and extrapolate to the kinds of holding periods that my clients have. And I don't know about you, but I've had clients where they inherited the stock, they couldn't sell it, and they died with the stock. And it's just, I mean, there's some cases that you hear of where people go their entire lives and hold this stock, not necessarily because they want to, but because they have to. This also incorporates something that Espen talked about in his work, which is that the discount, as you extrapolate it, it's really a quadratic extrapolation, because you can never get a discount that's more than 100%. So even if you go out 100 years, the discount can't be 100, it could be 100%, but it's not going to be more than 100%. So, you know, I looked at all this stuff, and I have been puzzling over this for many years. But the light bulb went on in 1998 at this conference in Maui when Dennis Dolan, who was the restricted stock trader at Nomura Securities, got up and started to talk about how the investors invested in restricted stock. Now, this was right at the moment in time when the holding period went from 2 years to 1 year. And so I think that was probably why he was asked to speak at the conference. And what he said was, you know, the buyers in these cases look at the time frame that they're going to be holding the stock. They look at the potential appreciation or not in the stock. They look at, in other words, what is that future residual value going to be? They look at their required holding period and the required rate of return. And so it's really a probability-weighted discounted cash flow analysis. And I don't think a lot of people really picked up on that, but I did. And I went and talked with the block desk at Lehman, and I have talked, and this was before things got bad with them, but when they were still a firm, but it was, you know, this is the kind of stuff that people use to get to these discounts. Behind every discount is an income approach. Underneath every discount is an income approach. What he said was, you know, our people use between 25 and 30% required rate of return, and we have a one-year hold, and we expect there's going to be some kind of appreciation in the stock. So if there is a 5% appreciation in the stock over a one-year period, your discount's going to be somewhere in the 20 to 25% range. Because you're going out at 5% growth, and you're coming back at a 25 to 30% required rate of return, so the discount's naturally going to be somewhere in the 20 to 25% range. You take those concepts and you put them into the kinds of holding periods that my clients have, and probably your clients, and you think to yourself, all right, so how long is my client going to be stuck in this stock? If I purchase this stock, how long will it be before I can get out of this thing at a pro rata value? And, you know, what's that future residual value going to look like? And what is my required rate of return? I mean, this is a minority interest in a private company. What kind of risks are there? And how do I get that required rate of return? Well, so we'll get into the required rate of return in a minute, but you just take the math of it, and let's assume a 5% growth rate, you know, holding periods, you know, from 0 to 30 years, required rates of return from 10% to 30%. It doesn't take you too long to get to a discount of 70 or 80%. I mean, most of my stuff, you know, you're in there for a minimum of 10 years. And if you have any kind of risk involved in this private company, you're probably at a 20 to 25% required rate of return. 10 years at a 25% rate of return is an 82% discount. It's just math. This is not an opinion. It's only math. And here's a graph of what the math looks like. It kind of looks similar, doesn't it? Underneath every discount is an income approach. So the question then becomes, well, how big of a discount is too big? I mean, you get this all the time from people who want to have a high value. I could never believe that somebody would sell at a discount of 80%. It just, you know, nobody would do that. Well, guess what? If you go back to the restricted stock studies and you look at not just the averages or the medians, but you look at the high end of the discounts, you get discounts easily in the 70 to 90% range. And these are people who actually purchased restricted stock that will eventually become liquid, and they may or may not have been distressed, the sellers may or may not have been distressed sellers. We don't know. No one's ever done any research to try to find out what exactly happened in those circumstances. The question is, why? Why are these things happening? So the idea that no one would ever sell at such a big discount is completely unsupported by the evidence. Let me show you how you get a discount of 100%. I've talked with people in the private equity space, and talked with a firm that does secondary market private equity. They go out, they buy up used private equity. And there was a time when there weren't very many firms doing this. There are now quite a few more firms that are out there trying to get into this private equity market in a secondary way. What this shows is that the seller in this case put $1 million, $500,000, $500,000, $500,000, $400,000, $300,000, and $200,000. So they've, you get these capital calls. You keep pumping money into the thing. Well, what they do, what the private equity firm does, is they then take the money and they go invest it, and then they return it to the limited partners. Now, let's take a look at the cumulative investment line, right above the year-end pro rata NAV. So that gives you the actual net cash flow to the company, and so in the fifth year there, they've made money. It is actually that $625,000 represents a 21.6% total return on their investment, and it represents an 8.4% IRR on their investment. Now, it happens that the general partner, in this case, values the remaining portfolio at $300,000. The other thing, too, that's going to happen here is that there's another $200,000 that is going to be a capital call for another 2 or 3 years. The seller, in this case, does not want to have to put out more money. They're going to pivot from this investment into some other type of investment. They've got a strategic focus. They get rid of this thing and get into something else.
On the buyer's side, the main issue is what the portfolio is worth today, because it's assumed that future capital calls will be worth what the fund pays for them. The buyers I've spoken with go through each portfolio company individually, and they forecast future exit possibilities for each company. They then discount those exits back to the present at a risk-adjusted rate of return, which is usually at least 25 or 30%. In this example, after looking at each portfolio company, the buyer believes that the general partner is overvaluing the portfolio. Possibly the general partner is getting the $300,000 from some appraisal firm that's using control premiums to help him get values up to cost basis so he can avoid a write-off. The buyer realizes that the numbers are inflated and discounts the portfolio value from $300,000 down to zero.
In the meantime, so they put this out on the market and they try to sell it. In the meantime, there's not very many buyers. And so the private equity firm that I was talking to, they could purchase this for $1. And they could do that because there were not enough buyers out there to create a market. The seller was very happy to sell and get out of it so they could move into something else. They had already made their return. They're willing to sell at a discount, and a discount of 100%. And this goes on all the time. Not just, it's not common, but it does go on all the time. You have real people, investors, selling firms like this and selling at 100% discount. Now, like I said, the market has changed, and sometimes these things sell at premiums because the pension fund really likes this firm, and they really want to be in this venture capital or this private equity firm, and so they will purchase it at a premium because there's a lot of competition for these deals now. Everybody's looking for some yield. So I give restricted stocks a yellow light because I think there is some validity and some way to re-envision how restricted stocks are analyzed if they're looked at from the standpoint of why do we have these discounts, not just what are the discounts. So this method does not work, at least, except for partly perhaps for the restricted stock studies, but for the most part, all of the factors here can be proven not to be valid, and nobody who puts their money into these deals actually uses that method. Now, so the question is, where do we go from here if we don't have that model? I'm going to read you a quote from Francis Bacon in the 17th century. He was one of the first scientists to develop the scientific method, and he wrote a parable. In the year of our Lord, 1432, there arose a grievous quarrel among the brethren over the number of teeth in the mouth of a horse. For 13 days the disputation raged without ceasing. All the ancient books and chronicles were fetched out, and wonderful and ponderous erudition, such as was never heard before in the region, was made manifest. At the beginning of the 14th day, a youthful friar of goodly bearing asked his learned superiors for permission to add a word, and straightway, to the wonderment of the disputants, whose wisdom he sore vexed, he beseeched them to unbend in a manner coarse and unheard of, and to look into the open mouth of a horse and find the answer to their questionings. For 30 years, I have spoken with venture capitalists, investors in private equity, investors in limited partnerships, syndicated limited partnerships, people who invest in fractional interests in real estate, all kinds of people in these various markets. And I will tell you that they do it to make money. This is how it's done. You do it to make money. And how do you make money? At least as a minority owner, there's 4 things: dividends and distributions, a residual value someday in the future, a required holding period, and a required rate of return. Those are the factors that go into how you make money. One of the things I want to point out here is there's a big distinction between a required holding period and an expected holding period. Those are very different things, especially if you're an investor in the public market. You may have an expected holding period of 5 years or 10 years, but your required holding period is about a half a second. When you're investing in private minority interests, your required holding period and it should be maybe something like your expected holding period, because you're not getting out when you think you are. So it's required holding period. I want to also point out there's a difference between required rate of return, expected rate of return, and historical rate of return. We'll get into that in just a minute. But this is the return that you should demand if you're going to invest in this investment to account for the risks. So I'm going to run through just a couple of examples of how this works in action. This company is highly sensitive to the economic cycle. I think that there's going to be a recession in here, and I think they're going to suffer. But I don't think they're going to suffer the way they used to, because I think they have excellent management. And so this is what I based my valuation on, which came out with a 73% discount to the underlying value of the equity, and it's a going concern. We went through audit and settled on a 65% discount. So this works. It works with the auditors. You can explain to them how this works, and they will understand that. And sometimes they will actually come to an agreement. Here's another one that went through audit recently. Now, this company right here is a vineyard holding company, and it's limited partnership interests. The lines that you see here, look at the one that's purple. It's kind of on the bottom at the beginning, and then it goes up with the green line. This is the after-tax cash flow to the limited partner. And the reason that it doesn't kick in for a while is because they first of all have to pay down their debt, and they second of all have to fund some replanting expenses. So this partnership right here is a vineyard partnership, But it doesn't look too bad, you know. I mean, after a while, you get some cash flow, right? It looks like pretty decent cash flow. What I didn't show you was what the actual net asset value was on this. And that's the blue line at the top. These things make very little money, relatively speaking. And I think I was talking with Chris Trahern about this, about ranches and farms and agricultural properties. These kinds of things are notoriously overvalued relative to their economic return. But people do it anyway. And by the way, in this particular partnership, you would be in this for 30 years at a minimum. These people only buy property. They never sell property. You will not see a residual value. I don't think you actually will see a residual value. So we went through audit with this. It was a 90% discount. And the IRS agreed to a 73% discount, which I thought was just, I mean, I would have really liked to have gone to tax court on this. But of course, you have to be careful what you wish for. Here's another one. This is a really good little company. Owns a bed and breakfast. Good cash flow. 59% discount. Just so you'll know, so what you do, and this gives you some kind of a window into the end game on this thing, which is that it's you get your initial return, your required rate of return, you get to the value. You go back around and you calculate after you're done sifting through all the information. And by the way, if you look on this, you'll also see there's a capitalization of earnings in this, because I also look at the secondary partnership market and get market transactions that are similar from the standpoint of yield on net asset value. So you can calculate value in a variety of different ways using the income approach. But what you do when you're done is you go back and if you've got a discounted cash flow analysis, you can reverse engineer it using a goal-seek function in Excel to get to the IRR that equates the value with the future cash flows. I do this on a pre-tax basis and an after-tax basis. And the reason I do it on an after-tax basis is that when you invest in something, you're investing after-tax dollars. What you want in the end is you want to end up with more dollars in your bank account after taxes than the dollars that you put into it at the beginning. And so that's why I think it's really important to think about after-tax investments as well as pre-tax investments. And so it's an iterative process. You kind of have to go back through it several times to figure out where the value balances. This is a 59% discount in a really good little company, and I think it would stand up in audit. Not to make you think that everything I do is it has a discount. In this particular case, it was a 95% premium to the net asset value. The client, in this case, wanted a low value, and I said, I'm sorry, you know? This company right here spews out about $300,000 a year in distributions, and the problem is that it has a 3-year lease, and it will be out of business in 3 years. Well, so the company itself was not worth anything, because nobody would buy a company with a 3-year lease. But you would certainly be able to find a cash flow buyer who would buy $300,000 a year for 3 years, and it was pretty steady stuff. So in this case, the value was higher than the net asset value. Earlier today, we heard a discussion by the attorney who was talking about Delaware Chancery Court and the problems with discounted cash flow. Dr. Pratt and Mr. Grabowski were on the panel. And one of the main issues that you have is that discounted cash flow analysis is subject to so much judgment that you can basically get any value you want, including the value that your client wants. Well, the problem that I see with that objection, the courts want certainty. They want proof. They want they want everything to be just buttoned up and really, you know, without it, you've got to get a number and you have to prove that number. The problem with that attitude is that that does not exist in the real world. The thing is, we don't live in Disneyland. Things are not neat and tidy. It's not, you're not able to actually prove all this stuff. I don't think you can do that. The only thing that we really can do, I think, is to get some kind, there's a couple of thoughts here, but the most important one that I think is that we need to develop some kind of language for talking about the uncertainty that investors have in the real world and how they handle that uncertainty. Because that's the key issue here. How do real investors actually handle that kind of uncertainty? So what I was thinking about is using some kind of a probability distributions on the various factors that we talked about, which is distributions and dividends, a residual value, holding period, and required rate of return. You could put a probability distribution onto the holding period, for example, and you could show this is a crystal ball screenshot from crystal ball that you could put some kind of a probability distribution on it that would be that would express the likelihood of a 10-year hold versus a 20-year hold versus a 30-year hold. And you could do the same thing for your required rate of return. You could do the same thing for your cash flows over time. And I thought, you know, this would be really logical because it basically mirrors the thinking process of the investors. The investors think in terms of probabilities. And, you know, what's the probability that we'll lose all of our money? What's the probability that we'll make 10x? What are the factors on that probability? And so my thought was, oh, well, this would be good. Now, I haven't done crystal ball, and I was going to go and buy crystal ball because this is the kind of output that you get when you run it 10,000 times. It tells you that value really is within a range. And, you know, based on the probability functions that you put onto the factors and you let it run, it'll give you a probability function like this. Right now, what I do is I'll look at different scenarios and I'll put probabilities on them. I thought this would be a really slick way to be more quantitative about what actually goes on in the minds of investors. Now, we've talked about, you know, dividends and distributions quite a lot, residual value, and required holding period. One of the gnarliest things about this is the required rate of return. So I'm going to spend a few minutes talking about required rate of return. You can't get a required rate of return using this information. This is CAPM type stuff. This is stuff that's backwards looking. This is one of the most interesting ways to lie with statistics that you can come up with. Because this was that chart from 26 to the current time showing that small stocks usually make more than big stocks, which make more than bonds, and which make more than inflation. And so we've bought in to this idea that this historical analysis gives us something that we can hang our hat on. In the Pratt and Grabowski Cost of Capital book, which you're all going to purchase after this session here and have Dr. Pratt sign it for you, this is one of the best little graphs in there. It's exhibit 15.14, and it shows the time frames in which large stocks won and small stocks won. This is just one example of why the backwards looking data mining process does not work. So this is for all the various holding periods since 1926. So on the left-hand side, you have the longest holding period. On the right-hand side, you have the shortest holding period. Well, this line right here shows you what you would have, who won, large stocks or small stocks, in a that line right there is expressed as a constant 5-year holding period. So if every single year you invested in small stocks and you kept it for 5 years, that line tells you what your, who won and who lost. I think this line basically says probably 30% of the time, maybe a third of the time, large stocks won. Well, and look at this place right here. 1983 to 2013, if you had invested in small stocks in 1983, you would have lost compared to large stocks through that period of time, 30 years. That's a long time to be in the wilderness. The point here is, and people that want to have a high valuation will go and say, oh, there's no small stock premium. Look at this. They didn't win for 30 years. And there were articles written about this. And of course, the whole point of what I'm saying is, just because they didn't win doesn't mean they're not more risky. They need a higher rate of return. The question is, how do you get that higher rate of return? You can't get it from the backwards-looking data. You can only get it from forward-looking data. So I went and I talked with some people who make these kinds of investments, secondary market venture capitalists, secondary market private equity. What kinds of rates of return are they looking for ex ante, which means before the fact? They are looking for rates of return in the 40 to 50% range. All right? And these are companies that they're investing in, which are just like very much like the companies that we have, except that they're intending to sell them at some point. There is a liquidity event out there in the future, and so there is a definite time frame that they will get some liquidity. Those are pretty high rates of return. Dr. Paglio also showed you some of this earlier today. This is totally forward-looking material. The Pepperdine study is about 10% of what we need. There's just a lot of ways that this needs to be improved, but I've talked with John about, why don't you go and ask investors in the public markets what your required rates of return are in the public markets. I think that would be really instructive. Bruce Johnson also put this out. This doesn't give you the complete required rate of return, but it does give you a cap rate. And what you see here, basically this data says people are looking for, at that time, about a 10% cap rate, and they were also looking for 20 to 25% rate of return total on the investment before these limited partnerships dissolved. So the question is, all right, so given all this information, what kind of rate of return do we need to have on Uncle Joe's family limited partnership? Of course, I'm lying with this chart here because I organized it in such a way that it looked like it was going to be bigger at the bottom, because all the numbers gets bigger and bigger as you go down. I don't necessarily think that's true, but that's the question. This is kind of the data that we need to start thinking about. So in conclusion, the discount for lack of control, lack of marketability, and liquidity don't work. No investor uses that methodology to get to the value that the price they're going to pay for something. And I just want to let everybody know that I'm just standing on the shoulders of a bunch of other people. This is not new with me. If you go to the SEC, they won't even consider this kind of stuff. Delaware Chancery, state courts, There have been some appellate cases. I don't know if Richmond is going to get appealed, but if it did get appealed, there might be a complete reversal of that decision. But the ones that were reversed, and I'm going on the information from other people, I haven't read these in a while, is Church, Jelke, and Dunn, and there's been some others too. So this is something which has been bubbling up for a long time. There's a lot of people who understand this. What I would just basically say is try it. Give it a shot. Eventually, you may get to the point where the income approach becomes your primary method and the discount analysis becomes kind of a sanity check. We need more and better science, better survey data. We need to get into the heads of the investors and replicate their thought processes. I think that's it. Thank you.
Thank you.